How's everybody doing? Welcome. My name is Big Daddy Max. I am a professional options trader. I've been trading options for 5 years full time. I started off my career buying options, but in time, I was very successful, very fortunate, more lucky than anything. I moved on to selling options, and I created strategies over the last 3.5 years that I back tested, I checked, I logged, I did everything I fucking could possibly do to make sure that these are strategies that I can bring to the table that will work, sustain, and continue my growth and my education in options trading, right? So first thing I'm going to do is I'm going to pull up my charts here. All right. And the first strategy I'm going to cover, we're going to jump into credit spreads and my credit spread strategy first, because if you get a great understanding of the credit spread strategy and the basics of how that works, then you'll be able to move on to iron condors with a better understanding and knowledge base, right? So we're going to start with credit spreads, and this is going to be fascinating. So in this little credit spread, we're going to go over candlestick analysis, price action, support and resistance, and some other things as well. So you're going to get a little bit of knowledge in a few of those as well. Whale, do me a favor.
Yes.
Replay function here. Pick a spot, any fucking spot on this chart. This is the daily chart on SPX. So pick a spot anywhere.
Right there. Wait, yeah. Nope. To the left. Left. Right there.
Bang. All right. We just picked a random date and time. We have no idea what happened on this day, right? There's no clue, but I see that SPX is at 35.85. Wonderful. So what is a credit spread, right? A credit spread is an advanced option selling strategy where you simultaneously buy an option and sell an option at the same time. So in your broker, if you were to come here, you can see this is my small little wheel account that I do. I'm doing a small account challenge. If you come to vertical, your broker will call a credit spread a vertical, right? Because it's a vertical spread. So what you would do here on a call side is you would be selling this short leg a short leg, and you would be buying one further out of the money on the call side. So this is what a call side credit spread would look like. On the put side here, you would be selling a short leg at 41.25, and you would be buying an even further out of the money one. So it would look like this here. This would be a put side credit spread. So making sure that you're selling the leg that's further or that's closer to the price action, and you're buying a leg that's further away. This is a great strategy from naked options because on consolidation days or trend days that you don't want to necessarily be worried about the price action, you can enter credit spreads. It's very high risk, very, very high risk. And I'm explaining why. The collateral on a credit spread, if I were to have a 5-point spread between the strike prices, that's $500. So you need to have your risk management in place so you can understand that you can lose up to $500. But when we cover the strategies, I'm going to explain to you how you cannot and how you can keep the risk to reward multiple at a fair and average price. So let's go to this day here, right? And I'm going to do something real quick. I want everyone to pay attention. So this is the first candle of the day. First candle of the day looks pretty good. I'm going to zoom in here. I'm going to get my horizontal line tool, and I'm going to draw my opening range. And if you take a notice, you'll notice I'm on the 15-minute chart, the 15-minute chart only. So doing that right here, you'll see I like to keep it very tight right there. Perfect. So now we have our opening range to the top and our opening range to the bottom. This automatically becomes a somewhat level of support and resistance intraday. So now what I need to find is my previous highs and my previous higher highs. So that's going to be my next lines. What I would consider these is my stop loss lines. So now I have my opening range and I have stop loss lines. What I would really like to do from there is find some entry criteria lines. So lines just a little bit further out of the money, right? Where I can have my safety zone and I'm able to enter these options without any issue at all. Is this the all-time high? Yep. So for all-time highs, I like to go an additional 10 points out of the money. So if we're at 36.45, I'll go to 36.55 right there. And so now I am set up. I have everything I need for my intraday price action for my credit spread strategy. What I did there was I did my opening range lines. I did my stop loss lines, and I did what's called my entry criteria lines. So the entry criteria means that if it's a 36.55 high, that means my call side credit spread, the sell side, cannot be lower than 36.55, right? Because these are based on price action. This is based on previous levels. So we cannot break the entry criteria line. It's based on higher highs and lower lows. So as we're looking at this, this is the setup here. So if I take a look at the price action now and how the strategy works, first thing I notice is we have a gap up, right? The gap up candle, it's not within the price action of the previous day. So we're looking at a gap and not a lap. It's a pretty bullish candle, but we saw some minor selling pressure at the end. So now I want to see the next candle. The next candle was a reversal candle. We made a lower high, but we didn't make a lower low, and we're still trading within range. Overall, if I had to assume a posture of like right now, I would say I'm neutral, right? Because the first candle was bullish, second candle was bearish. So I'm neutral right now. I don't have anything I can do really on the day. This candle as well, very neutral. We're 45 minutes into the day now, and the price action has barely moved. So I'm really looking for my confirmation candles. And right here is what I get. Fourth candle in, right? And what do I get here? So this is important for everyone to write down. This could help your day trading as well. Even if you're still going to just buy options, what I'm about to tell you is a game changer. If you just look at these four small confirmations, right? Did this candle, this bullish candle, confirm the previous candle? Was this candle bullish? Yeah, you could say so, right? Overall, it was neutral, but it was bullish. This little flag pattern that played out. Did we make a higher low? Right? You absolutely did there. You could see the higher low. Did it make a higher high? Absolutely did. So we have two confirmations there. Third and fourth, did it break opening range and close on the outside? It did. So now that I have all four of my confirmations, I would enter my put side credit spreads. I don't want to be on the side that's trending, because if it continues this trend and I open 36.55, I'm putting myself at risk. So I want to put myself at least risk possible. So in this case, I would enter the 35.37s or the 35.40s if I could enter those right around my entry criteria line. So let's play this day out here. A lot of people don't understand the massive points that the first 4 or 5 candles can give you and the amount of data that you can get throughout the rest of the day. So as we play this day off, we see a reversal here, very strong, but it's still an opening range. And we're coming up to 3 o'clock now. And my entry is way the fuck down here. So we're never even at risk, and the day closed, consolidated and choppy, put side or call side would have been a winner on a day like that. But based on the entry criteria of this credit spread strategy, that was a win to the put side. Now, all I have to do here is adjust my opening range lines, and bam, we are right back in action. All of my things that I need to do for the next day are totally done already. It's as simple as that. How can I predict an entire day's worth of price action in the first hour? Well, let's take a look, right? Let's break it down and fucking talk about it. What I have here is a lap down because this candle is still within the previous candle's price action. We have an extremely bearish candle, deep red, sold off. A candle like this, I'd be in shock if the next one wasn't red. So let's take a look. Bang. The next one is red, right? As stated. So now we're getting tons of information from this candle. What are we getting? We're getting a lower high. We're getting a lower low. It closed and confirmed outside of orb. And did the second candle confirm the previous candle's price action? Were they both bearish? Abso-fucking-lutely. So without hesitation, I enter call sides now on this breakdown. Does that mean it can reverse and I can lose? Absolutely. But based on the strategy that I'm entering right here, I would have entered call sides on the second break of confirmation that we got there. The reason we choose a stop loss and an entry criteria line based on previous higher highs and highs is for this reason right here. Even on a reversal day, we're able to continue to have safety within our margins. So bam, there's 2 for 2. I don't even know what day of the year this is, but I'm 2 for 2. And I only have to move my lines here now. And I've only been trading on the 15-minute chart. I've only been using candlestick price action as my entry criteria. Do you see any fucking indicators on this screen at all? Absolutely not. All you need is good price action and to understand candlestick analysis, buying and selling pressure, and have a strategy that governs the trade, right? So let me do one more for you guys. Right now I'm 2 for 2. I'm feeling hot. I'm feeling fucking good. I'm feeling froggy. So I really want to go 3 for 3. So let's just see what we got here. First piece of information that I get from this first candle is what? There's no gap. 0. No lap, no gap, no nothing. Got it. No 10 a.m. gap rule is in effect. What do we see on this candle? We see a big green candle, right? A little bit bullish, but then what do we have? We have a new lower high, a lower low, but we did not confirm and break, nor did this candle confirm the previous one. So I don't have criteria for entry yet, but overall, it looks neutral to me. Could break to the downside, but it looks neutral. Oh, I messed up and I did 2 candles. So right now it's still neutral. I have no data to go off of. We need our confirmations before we can make a move. So now we're testing the top of range, 6 candles in. This is where I would enter an iron condor, but for the sake of this exercise, I'm going to just stick to the credit spreads. Right now I have 0 confirmations. Maybe the next one gives me what I need. Bang, right there. Uptrend. Confirmation, higher high, higher low, and a wonderful close outside of orb. I can enter my put sides now at this time. That's what I've been waiting for right there. Of course, you get a nice little reversal. Here's a newer high. And usually for a day like this, it's choppy consolidation day, which is why I would have taken an iron condor, but I will explain that to you guys when we get to the iron condor portion. So 3 p.m., we're at 3:30, a huge reversal on me, and we're still good. The stop loss was at 35.52. It closed at 35.67. We had no issues at all that day. And yes, you can sell SPX options 70 to 90 points out of the money in the morning, just like this. So that's 3 for 3. We had a very interesting move to the downside here. So now what happens in the strategy? Well, firstly, we have to move our stop losses and entry criteria to match the new price action, right? So I'm 3 for 3 right now. Now I have my orb, my opening range breakout criteria here, but now I want to lower this stop loss line to the lower high, and I want to lower this to the higher high, right? So that's about 36.28. That's about 70 points out of the money, 60, 68 points out of the money. That's solid. That's a good line. Now here, I want to move this a little bit lower, and I want to move that a little bit lower. So now we're good. So you can see the put side is very close. The call side's a little bit further. So it would be better if we have a breakout to the upside. So that's the credit spread strategy, and this is what it's based off of. It's based off of price action, candlestick analysis, and making the decision on the opposite side. Remember, so just to show you how the full thing would work here, we have a small gap down. We have a bearish candle, but it had tons of buying pressure into close. So it looks like the next candle might be green. Let's take a look. Bang, next candle's green. You can read the candlestick analysis and see. We had a neutral candle that broke out. So what we have is a higher high, a higher low, a break of confirmation of opening range, but we didn't really confirm the previous candle, right? So if we take a look at this price action here, I want to see one more. I want to see a continuation. And so we didn't get the continuation, we got a reversal. So now the reversal, this is what's going to keep us from entering because we didn't quite get all the confirmations we need. We need a breakout. So this breakout is more sustainable. If we have another green here, we could have entered, but we didn't. However, we've closed above orb now twice. I am inclined to take put sides. We are above the opening range. There is an intraday uptrend. We did make a newer high and a higher low, and the previous candles were bullish. So now at this time, I would enter put side credit spread. So if I see my 35.12 is my stop loss, 3,500 is my entry criteria. So I'd come to my SPX, I'd come to my vertical, sell, right? Sell side has to be 3,500. So then you'd come all the way down to sell 3,500 and you would buy one further out of the money. So you'd have to go to, it's at 34.50 because of where SPX now is today, but you understand. So right here, this is what it'd be 3,500, 34.90. So I would have entered right then and there, and I would be looking for an uptrend to begin or hold at that level. So I'd be in usually around this point here at 1 o'clock. You could begin to trim your profits if you treat it like a normal day trade. This was a total sideways day, but we are making newer highs, and we're on the put side. So you could take profits at any point during the day now. It was a nice breakout on the upside. We were in put sides. We might have gotten some real good premium on that credit spread. So that's 4 for 4 now. From looking at the first I think I looked at 6 candles. One of them I looked at 2. So I'm 4 for 4 now. I'm going to do one more because I want to complete the week. I want to go 5 for 5 in this strategy. So we don't really have to move our stop losses or our entry criteria lines now. Using the credit spread strategy, all we have to do is zoom in and tighten up our opening range. We want a real tight opening range so you can confirm the breaks. So let's do this one more time. We're on Friday. It's Friday. Fridays are for fucking profit taking and not for over trading. Also, when I'm using the strategy, I only trade once a day. I only do this one trade and I'm good for the day. I don't need to go crazy and do a whole bunch of other shit because this is more than enough for me when you have something like this in your option selling toolkits. So I'm going to hit play because I have a semi-bullish candle here. That's really the only information that I've got. Then we have a huge red. Huge red makes a lower low, lower high, closes outside of orb, but this was a bullish candle, so it doesn't really confirm the previous candle. So I want a continuation candle here. Bang, that's what I'm looking for. The continuation candle, lower low, lower high, close outside of orb, and does it confirm the previous candle's price action? Absolutely does. So without hesitation, 36.46s. What is that? Yep, 36.46. So on the call side, you'd come to the call side and you would sell closer to the price action. So it's 34.50s, and then you would buy the 3400s. And this is where you'd get a call side credit spread right here. Or excuse me, you would sell the 3400s and buy the 3450s. So this is exactly how we would set it up. We would enter without hesitation here because we have all confirmations. This is the third candle of the day. This is third candle. We're sitting at 10 in the morning. We're drinking our fucking coffee. We're having fun just like this. And Big Daddy Max is going to say, let's go call side today. Can it reverse? Absolutely. Does it need to break opening range? Sure does. It's noon. It's 12:30. It's 1 o'clock. We're taking profits now. Even if it goes green, we're taking profits because we're so deep and we're so opposite of where the market is. We can do whatever we want. Here's a bang, bang, bang. Good thing we're on the call side today. And that's it. Call it. That's a week. One whole week for you guys live. And all I did was look at candles and adjust some lines. Let's think about that for a second. All I did was adjust some fucking lines and look at some candles. And that's 5 for 5 on the credit spread strategy. That's the most important piece here. It doesn't have to be hard. A lot of people like to overcomplicate trading. They like to make it way more than it is. They like to fucking deck out the indicators. But what is trading? What is stock price action? It is buyers and sellers playing tug of war. So if you see the team in blue is whooping the team in red's ass in tug of war, then the team in blue is the one you want to be on the side of. So that's it. So that's how I can take my strategy, my credit spread strategy, and I can go 5 for 5 in a week. Now, there's some ways you can play with the credit spread strategy to mitigate risk as well, right? Because what is the most important thing with options trading is mitigating your fucking risk. Because when you enter a trade, you know what you have at risk. So on a day like today, let's go to a new day. I don't have to move anything but my entry criteria line, or excuse me, my orb. And I want to see, bang, here's a good example, right? 2 candles in. Very bullish candle, higher high, higher low, confirmation close, and did the candle confirm this next candle? Absolutely did. I want to see one more, just a little bit of green. Okay, so that's it right there. That's why we wait for all of these confirmations, because this kind of reversal is how you get crushed. Now look what happened. 30 minutes later, if we were to prematurely enter put sides here, we would be getting crushed. We might have even been stopped out by now. But now we have a lower low, lower high, and we have a close outside to the downside with a continuation. Choppy day. So if you did, let's just say we took put sides right here. And now we took call sides right here. Now we're in an iron condor. An iron condor is a four-legged option strategy where you simultaneously have a put side credit spread and a call side credit spread open at the same time. So if I were to go to my broker now, I can click on iron condor. I like to do the call side first and then the put side second. So if you look here, and I like to do my sells first. So now my call sides, I'd be in 3645s or 3650s, and my put sides, I'd be in 3500s. But that's a great way to mitigate risk because one credit spread can be at risk and the other one is a guaranteed win. So that's one way you can take off the losses. You could play both sides of the field and get creative with this option selling strategy so you can trade safer. It's not safe. It's very high risk. It's very high risk, but it's a good way. So now if we play a few more candles, we kind of want it to stay in range. If it doesn't come near our stop loss, but it stays near that opening range, then puts and calls are both going to print. So right now, around the 1:30 to 2 o'clock mark, we are still in opening range. The iron condor was an absolutely perfect play here. And that's how you could stay on the winning team side. Like I told you, it's tug of war. If at first green was whooping red's ass and we're gonna give some juice to the red side, but then red starts whooping some ass, fucking jump ship and go to the other team. Mitigate your risk. It's that simple. You don't want to sit here and fight against the price action. We want to be fluid, just like the liquidity in the market. We want to move our shit around just like them. So I would have taken an iron condor on this day and without worrying at all. Look at this. Bam. We closed in opening range at 4 o'clock. We closed right above where we were 3 points south of where the market opened. And I was able to determine to enter both and mitigate the risk. That's 7 for 7 trades now in 6 days by using the credit spread strategy to stay on the winning team's side. So let's talk some questions real quick.
Yeah, somebody's asking how you handle economic factors.
And how do I handle economic factors, right? So there's two types of economic factors. There's the normal news, like yesterday we had the Fed Bostic from Atlanta and those Feds speaking. And then we have what's called high importance news. That's your Big Daddy Dick Jerome Powell. That's your PMI. That's your FOMC. That's the ones that are really going to drive the market. So when we have those days coming up, I do not trade at all on this strategy. So that's one thing I want to make very clear. I don't trade it because the volatility in my back testing, the most losses were on high importance economic calendar news days. So it's better to just sit on the sidelines, enjoy my popcorn, and then be reactionary. So the next day I can come in, look at the previous price action and say, okay, now I know where to attack and continue with my win streak like I'm on right now. I'm on 7 for 7 right now. So for everyone asking, tomorrow is FOMC minutes at 2 p.m. I will not be trading tomorrow. Not at all. That is a high importance news event in the market. Let's talk stop losses. Wonderful question. Since the risk to reward ratio is a little off on this, right? My stop losses are here. The yellow lines are my stop losses, but those are last resort stop losses. If it were to reverse on me and I were to fall 200-300%, I would close the trade. If I were in call sides here, you know what? Actually, a perfect example is today's price action. We started off bullish, and if I were to enter put sides and then news breaks were coming out and tanking the market, I would have a hard set at 300% no matter what. So if I come to the vertical here, if you go to limit, stop limit, if I were to open this at, let's just say it's normally about 20, then I would have an activation price of about 60 right there, about 300%. Because I know statistically, this strategy has a 93% win rate. And for me to have a 3-to-1 risk to reward ratio, that means I need to have a 75% win rate or higher to be profitable. So I keep a very loose risk to reward ratio just so I can continue the consistency and the winning streak over the R multiple being positive. So that's where I do that. I only do this for SPX, but I have back tested it on singular stocks and it works. I do it on ETFs because it has the most volume and liquidity, and because you're going to always have those degenerates that buy fucking 90 points out of the money options. And then I do it on SPX as well because the premiums are very nice. And as an option seller, when something is that volatile, the premiums are always nicer. So let's talk about implied volatility. Implied volatility is priced into options contracts through the Vega. It is the one standard deviation of where a stock could be based on a futuristic outlook. So if the IV on a normal stock, if you pull up an options contract right now, we're going to pull up Apple. Let's go to the options chain and let's go to a weekly, right? Here's the theta, the delta. Let's fucking add some implied volatility. What's the IV? I don't see a way to change it on here. Oh, here, is this it? Here we go, implied volatility. Let's add that one in there. So now we have the IV. It's closed. Let's go to next week. So here's implied volatility. You can see the strike prices on a normal stock like Apple. The implied volatility and normal market conditions usually sways between 25 to like 45%. When we look at things like SPX and 3X leveraged ETFs that I sell options on, the implied volatility is always far greater. So look at the implied volatility on this $6 stock. You notice the difference on the left and right there? We went from 30% to 130%. Now, when the IV is priced in through the Vega, that is more volatile for options buyers. But as an options seller, how do I view that? I view that as free fucking money because I'm playing these stocks that are still following technical analysis, still following the strategies that I use, but it's pumped up with IV, right? We've all heard the term IV crush. What is that? That's exactly how a implied volatility options contract tanks after a large news event like an earnings report, CEO being fired, or if they change the outlook on their guidance, stuff like that. So IV for option sellers is good. We want implied volatility. We want juiced up premiums because you're the schmucks that's buying them for $200. I'm the guy that's selling it to you for $200. And last week it was only worth $100. So you're buying fluffed up price. It's like you're going to the dealership and you're getting that fucking brand new Dodge Charger with a 28% APR. That's how I used to tell all my soldiers in the military, don't go fucking buying a brand new Charger, motherfucker. So that's IV is a good thing. And it plays into the strategies that we use as option sellers. The first one that I just showed you there was the options credit spread selling strategy. So if you have
IV crush is definitely on Max's side. He wants the IV crush. We're all afraid of it as day traders. As a seller, that's what you want.
Absolutely. So now let's do one more here. I'm going to keep doing these throughout the show just so you guys can see. We had a nice little price pop to the upside. So now I need to come back up here and my yellow and white lines again, right? So I want to move them out. So I usually do a previous high, but this is only within 26 points, 29 points. So it's really too close for me to feel comfortable. So I'm going to move those again and I'm going to go 10 points out. So I'm going to go look like this now. This is the setup for the day. What do I notice? Let's talk out loud. What do we see here? We see a gap up. We see a neutral but bullish looking candle. What does the second candle show me? We have a decently bullish candle, newer high, higher low, and closed outside of the opening range. Can I get a third one for confirmation? Absolutely. Without hesitation now, I would be entering put side credit spreads. But before I do that, I need to cover something with you guys that you may not know. This gap, there's a rule put in place from one of the best options traders I've ever met. He calls it the 10 a.m. gap rule. And the 10 a.m. gap rule states that by 10 to 10:30, if we did not make a newer low to fade this gap, that means that we're most likely going to gap and go which is the other opposite side. So you can gap up and go and continue the uptrend, or you can gap up and begin to fade the gap. And so by 10:30, if we do not make a newer low, it is best for me to look at the price action as it's going to gap and continue. So in this right here, everything is pointing up. Does that mean that it can reverse and not fill the gap? Absolutely not. It could drop like a fucking, like you dropped a 10-pound weight right now. But based on the price action, based on the 10 a.m. gap rule and everything, those three candles has shown me, tells me I'm going put side credit spreads today. And I think that it's going to continue uptrending. And what does that look like? Does everyone see this? If you were on the call side today, you just got absolutely obliterated because it pumped up. Look at this, almost right below the stop loss. You would be down hundreds of percent. While I'm sitting on the fucking put side and I've been outside playing with my dog for 2 hours already because there's nothing to worry about. Bam. Does everyone see that? That's a perfect example of a gap and go and how the 10 a.m. gap rule is applicable to any option strategy, but primarily one of the key ones for my options selling strategy here. So now I'm 8 for 8 with ease while explaining it all to you guys on this random day. Hard to be mad that this is the guy selling me the contracts. Yes. That's funny. I've been selling all you motherfuckers contracts. I hope you like me now, bitches. So let's talk more about implied volatility and the little sister company there, the Delta and the Theta, right? We all know what Theta is. Theta is time decay on the options contracts. Time decay gets more and more aggressive closer to the expiration date of a contract. So if you have a Theta of 0.05, that means every day that contract is going to lose 50 cents right off the top. No matter what happens, if the price goes up, down, your options contract's down 50 cents. Theta is one of the biggest restraints from being a successful options buyer. But what happens when you switch the field? What happens when you're an options seller? Options selling, that means Theta's working for you. Theta's on your side. That means for every minute, every hour that passes by in the market, that contract that's getting crushed by Theta, that is profit for me. That is an option seller's dream. That's our maintenance man. That's our fucking best friend. That's our homie Theta. He is your full-time employee as an option seller. And he's working extremely hard for you to bring that fucking money to home, to the option selling community. So having Theta on our side is one of the biggest advantages of being an options seller. Another one is the Delta. So the Delta, when we're looking at the options Greeks, has two primary functions, right? So when I come here, you notice the delta of these options contracts. So let's go back to SPX so I can show you guys this, right? Delta has two primary functions. The first primary function of Delta, so if you look at the call site here, the 4160, this is a 0.34 delta. The primary function of Delta is the rate of change of the underlying stock. So for every $1 SPX moves, the options contract will go up $34. That's the first function of Delta. Well, the second function is what is applicable for us as option sellers. That is also the chance of success that strike price, 4160, will fall in the money. So there's a 34% chance that it falls in the money, giving us as option sellers a 66% chance of success. But 66 is not a really attractive number to me. I like to go 60 points out of the money where I'm rocking a 0.09. So before you have to say, oh, Max is full of shit, he says he's got a 90% success rate. Look at the fucking math. The delta is a 0.09. And so based on the secondary function of delta, that means I have a 91% chance of success of selling this options contract. Because as an options seller, we want the contracts to come out of the money and stay out of the money. So if there's a 9% chance it could fall in the money, that means there's a 91% chance it stays out of the money. And that's what we want. So for my basis on all options selling, I only allow my delta to be at a 0.2 or less. That gives me an 80% chance. Oh, my boy Paper. Let me get Paper Gains up here real quick. Another option selling beast with me. Glad you're here, brother. Let me get that for you. If you can unmute now as well. So that's what the delta, the theta, the IV. So you hear all of these things in your options buying career, right? And everyone's, oh, theta this and theta that and delta this. And no one really breaks it down for you, though, to as an options buyer, how fucking shitty it is to have IV, theta, and not understand the delta, the price action, right? So knowing as an option seller that high IV is good. That's free money through the Vega. Having a low delta, that's good. That's my chance of success. Having a theta that's eating away at the contracts, congratulations, that's my security guard. He's going to collect for me. All of these things as an option seller work for you and not against you. And that's one of the greatest things that you're able to do and understand as an option seller. So I want the delta to be 0.2 or lower. So if I were to look here, I would only, if I was going to sell calls on this options chain, the first one I would consider is the 0.18. But we also need to consider the stop loss criteria and our entry criteria line. So if I go to enter these 3656s now, and the delta is above 0.2, I need to adjust my strike price because I'm too close to where I'm comfortable, where I have the greatest chance of success. Another fun statistic that I like to throw out here for options buyers, do you know how many options buyers quit trading options in their first year? Does anyone have an idea? If anyone knows how many options buyers quit trading options in their first year, if you say the right percent right now, I will give you a free lifetime membership to Max Options Trading MOT. The first person to say the right number gets a free membership for life to Max Options Trading. Let me see it. Blow it up. Let me see it. First one. I haven't seen it yet. This is statistics, so I'm very close. I see a few of them. Nobody yet. Bang. Ryan Krebs. Congratulations. Ryan Krebs. DM me on Twitter at Max Options Trade, Big Daddy fucking Max. You clicked on the link so you know who I am. 91% of options buyers fail and quit in their first year. And so what does that mean? That's a fun little statistic to look at. Ryan Krebs, you just got a free membership to MOT for life, baby. Good job. That statistic, if we mathematically add that into our equation, right? That means if 91% of people are quitting and they're buying options, if they just would have hit the sell button every single time, they would have a 91% chance of success, just like the delta. So that's something I always like to throw in there. Another interesting fact about selling options that's different from buying options. If I bought calls on this day, I would be profitable from here to here. I would be massively profitable. Great job. You killed it, right? Not knocking that. But if you had entered calls here and it went like this, you're losing money. As an options buyer, you can only make money if you buy a call and it rapidly goes up, or if you buy a put and it rapidly goes down. But if it rapidly goes up or comes back down, you're done for because of the Greeks that are working for me. If it goes up too slow, if it's a slow incline up, you're most likely done for because theta is going to eat your contracts. If it goes against you, you're done for because of the statistics of gaining an options contract back. You guys all know that if an options contract is down 20%, you actually need about 50% in gains to be profitable again, right? So it's a totally different ballpark. So as an option seller, what's the difference? Well, I entered put sides here and my stop loss was here. So let's look at this. If it tanked and went against me and bounces, I win. If it goes sideways, I win. If it goes up, I win. If it goes down slowly, I win. And if it goes up slowly, I win. Look at all of these scenarios, these fucking red arrows everywhere that played out where I could have made money that day. That is the difference between options buying and selling to me. That's most crucial. Is options buying, people are like, oh, it's 50-50, right? My analysis says the stock's going up, I'm entering calls. That's not necessarily true. The actual statistics of options buying to me, I think it's 30%. because of this shit you're seeing right here. Because unless the stock goes in your direction, in your favorable direction that you chose rapidly, you are not going to win. And when option selling that happens, you are going to win. So I think no matter what, if we total the math up here, 80 delta, 91% of buyers are going to fail. So 91% of sellers are going to win. And we have a 70% rate. What does that mean? That's the math. I don't have to sit here and bullshit. You do the fucking math. That is an 81% chance of success before you even enter the trades. Now we have a strategy that's governing our trades. And it's the Bible. We don't fucking break the strategy. We have tight stop losses in place. I set a hard stop loss when I entered the trade. Sell it, set it, forget it. It's that easy. And now I'm motherfucking motivated. So what I want to do is another day for you guys right here, because I think I'm 8 for 8. So what is this? This is my 930 candle. Let me adjust my stuff right here. Let me get my opening range, right? And we had a monstrous green day. So what I need to do is I need to raise my stop loss to previous lows, and I need to move my entry criteria line to lower lows. Does everyone see that? This is way too close, but this is all-time high. So I need to go, a safe buffer for me is 30 points out of the money. So I'm at 36.65 and 36.75 now. Let's take a look at the first candles on the day. I'm going to rinse and repeat this until it's drilled into every one of your heads. And tomorrow during market, you're going to say, shit, I just saw this. Did it make a lower low? Did it make a lower high? Did it close and confirm the previous candle? It sure did. Can I get one more to confirm that? What does that look like to me? It looks like a trading pattern that is bearish. Small reversal and bullish buying pressure, but overall, I'm still below our opening range. So without hesitation at this time, I would be opening a call side credit spread. Now, can it reverse and me take a loss? Absolutely. I'm actually wanting to take a loss so I can show you guys the risk management side, but it's looking like we're at 130 and we're back in range. So right now, if you consider this the reversal through the day, we were in call sides. Why not add a put side at this point when it broke back into range, turning your credit spread into an iron condor, mitigating the risk you have on one side? So now it's 130 and we have an iron condor, and it is just choppy consolidatory options trading. If you're an options buyer, you're very familiar with this right here. This is called range trading. This is called consolidation trading. This is called box trading, and every options buyer gets fucked on this time right here. This is where theta is working for me. IV is working for me. Delta is working for me. Sideways price action is working for me. So if you ever wondered who's making money on this bullshit choppy market, you're 100% correct in assuming it's Big Daddy fucking Max. So now let's go ahead and finish the day. Bang. We close right in the middle of opening range. Put side and call side would have hit simply. We weren't very stressed that day because the price action was choppy. Congratulations, we're 10 for 10 now in 8 days. I would be up somewhere around $2,000 to $3,000 at this point. You like pre-market when you trade or swing. So SPX doesn't have a pre-market, and that's why I only do the 15-minute chart. I use the 15-minute chart only. Max, did you make like 10 mil during March and April's range? No, I didn't, but I can tell you this, I did not miss one trade in April, not one day. I did this exact thing and I hit like 22 for 22 in April. So it is possible. It's very improbable, but it's possible. So now let's get set up and let's talk a little bit about iron condors, because I just brought it up that was a perfect day for an iron condor, right? The iron condor, so everyone remembers, that's their 4-legged option strategy, where we sell simultaneous right here, credit spread on the put side and the call side. So for an iron condor, for us to win, we really want this right here that we saw the previous day. That was the day, and you're able to use the candlestick analysis to understand that and to open an iron condor. It doesn't mean that every day is going to be a good iron condor day, but it's giving you the potential for a good iron condor day. Remember, on Thinkorswim as well, a lot of people don't know this. If I open up 10 credit spreads with 10-point spread. So on this day, right, if I opened up my 36.75s, 36.85s would be the buy. That at any point, I can turn that into an iron condor with no additional collateral needed. So if I have 10 contracts for 10,000 collateral, I can open 10 contracts for 0 in collateral and turn that into an iron condor whenever I want to manage my risk and make some potential additional profits. We're managing risk, but we're also adding risk. Right? The only time you're adding risk in options trading is when you're opening more contracts. That is how you add risk to options trading. And the only time it should be done is when you're managing risk, if that makes sense. It's very similar as a turning a naked caller put into a debit spread. You may have heard the term ghetto spread or something like that. Well, using the debit spread option strategy on a naked caller put to lock in gains is how I look at a credit spread. Why can't we manage risk and lock in gains on a credit spread? You can turn it into a fucking iron condor. So an iron condor, let's go ahead and bang out another day while I'm focused. So we have a gap up. We have a pretty bullish looking candle. And now we have a little reversal here, but it broke back into range. Overall, I'm neutral. Yes, real quick. I have back tested this strategy on singular stock, ETFs, leveraged ETFs, SPX, ES futures, and it's all synonymous. The strategy works if you follow it. So we're neutral now. Neutral, I got nothing here, right? Red, green, but I do know that the 10 a.m. gap rule is in effect. So the 10 a.m. gap rule is in effect, and that's telling me that if we make a newer high, we're probably going to gap and go. But if we make a newer low, we're probably going to gap and fade, right? So there's the newer high, but it rejected. So I'm not in yet. I want to see some more. So we're about 6 candles in, and we're still within range. This is perfect. What do you think the best option strategy is here? That we're still in opening range come 10:30, 10:45. What option strategy, chat, do you think I should enter here? That's right. You guys are absolutely right. You know what it's called? Fucking bird season, baby. It's bird season. We're going to go Condor. I am butterfly, baby. That's right, paper. We're going to save the butterflies for another masterclass. The Iron Condor, the fucking American bald eagle of options trading, baby. The Iron Condor. So now let's just say I enter the call and put side right here at the same exact time. So let's see what happens. We're pretty close. Let's even move our stop loss up and our entry criteria line. Let's make this tight. Let's get even tighter. Fuck it. Let's get real tight. Let's just see what happens. Let's get so tight that I can fucking squeeze out an egg between my ass cheeks, baby. Let's take a look at what happens. We're 6 candles in and the price action has given us nothing. So we're in an Iron Condor. Here comes a gap fill. Okay. Beautiful. We filled. Usually you see a reversal. We're back in opening range at 130. Bang. And then the day is over. Just like that, we close right at the, opening range mark there. Without hesitation, nothing went wrong. It looks like that was actually a half day in the market. It closed at 2, which is one of those strange holidays. But bam, Iron Condor, just like that. So
is this November? Probably Black Friday.
Yep. November 20th. Yep. You're probably right. So that right there is a perfect example of Iron Condor and how you can get both of them just like that. So without hesitation, we entered an Iron Condor because we can observe the consolidation period, right? Because of our simple but easy and fucking wonderful strategy on the 15-minute, 6-7 candles in. We haven't moved. So let's go bird season. So we open up both of them. We go Iron Condor. We have a nice, easy day. There was a drop, gap filled. Our stop loss was still 40 points out of the money. Congratulations. I think we're what now, Whale? What is it? What am I? I think I'm 13 for 13.
Yeah. Are we counting Iron Condors as 2?
Iron Condors is 2.
Okay. So then, yeah, I think you might even be 14.
14 for 14 now in about 10 trading days. Wonderful. Let's go to the next day. Perfect example of when to use an Iron Condor versus a credit spread But you should always have both of those tools readily available to manage your risk if you enter one or the other. And I'm going to say this yet again. Selling iron condors and credit spreads is extremely fucking risky. You're watching me go fucking ham right now, but I am a professional seller who's been doing this for years, and I'm showing you my strategy on it. However, you need to take this strategy and make it yours, because trading is the most individualized career in the world. Whatever works for me does not work for Big Daddy Whale Street. Whatever works for Big Daddy Paper Gains doesn't work for Big Daddy Max. So you have to take the strategies that I'm giving you, implement them, and go and turn them into your own. And that is the principles that you need to. I'm just giving you I'm leading you to the water here. You got to go drink it and make it your own fucking water bottle. I'm not going to go over option buying strategies. I will save that for another masterclass where you can learn about them. Let's take a look at the next day real quick. This is going to be my last one, and then we're going to go into covered calls and cash secured puts. I'm going to go over my wheeling, how you can make passive income in the stock market. We're going to go over some psychology of trading. Last one, baby. Can I go 15 for 15? We're going to go over wheeling paper. You know the fucking deal, baby. Wheeling and dealing. I have the term, I call it wheel estate. And I'm going to go over that with you guys here shortly. So we have a big red lap down, red, and confirmation. I don't even need to see another motherfucking candle. I'm in call sides. Now, I'm in call sides. Damn. I'm in call sides. It's noon. I'm probably at the gym. Not even close to opening range, so I'm still at the gym. All right, I'm probably leaving the gym now because I got to walk the dog. 3 o'clock. Okay, we're back in opening range, but it's 3 o'clock. It rejected, and congratulations. 15 for 15 live without even knowing. What is this? What year is this that we're doing?
I have no idea.
I have no idea. This is
2020.
This is 2020. So we're trading in December 2020, by the way. So if you guys think I'm full of shit or I saw this before, we picked it randomly throughout. So this is that's it right there. That's my credit spread strategy, right? So quick recap, key takeaways. 1, credit spreads and iron condors are very high fucking risk. You need to manage your risk. So yes, I target delta over the credit received. I do not choose premium as one of my entry criteria. I choose the support and resistance zone, the higher high and the lower low. And then I choose the delta secondly. Then the premium is my bonus to making a good trade. I've taken premiums as low as 2 pennies before, just to be right, because I choose consistency over profitability, because consistency creates profitability. So that is exactly, I do 0 DTEs. The strategy I'm showing you, by the way, I should have mentioned this, is a 0 DTE day trading strategy, if you didn't pick that up. I do have a swing trade credit spread strategy with momentum breakouts as well, but we'll have to save that one. Account requirements. Yes, you can do this with just a few $1,000. You can do this credit spread strategy on SPX with 1K. You could do it with $500 if you want to start getting your feet wet and start practicing. A lot of people think that selling options, I think the 2 biggest reasons people don't do it is 1, they're just not very knowledgeable, and without knowledge comes a level of uncomfortability. And I think 2, people hear option selling and they're like, oh, you need $100,000 to do that. Bullshit. You need $500 to do my cash secure, my credit spread strategy. You need $500 to do my wheel strategy. And I'm going to show you that now. Don't go fucking full port. So that's the credit spread. Real quick, second key takeaway after the high risk, you have to have the opening range, stop loss, and entry criteria lines. You have to wait for confirmations, which I've said it 10 times, but I want to say it again for you guys. Lower low, lower high, close outside of range, and does the previous candle confirm? We hear the word confirmation a lot, but a lot of people seem to have different ideas on what that means, right? Does this candle confirm this candle? Yes. Does this candle confirm this candle? Yes. Does this candle here confirm that our stop loss line, by the way, was a perfect fucking zone of support? Yes. That's why we use lower lows and lower highs. Does everybody see how that stop loss line rejected? So what if you did mess up and you took the wrong side? Congratulations, you're still good. You may have gotten stopped out, but this is exactly why I choose lower lows and lower highs. Look at the support and resistance lines between opening range and lower lows here, the stop loss criteria. So this is exactly why I choose those. And this is exactly why I have this strategy and my risk management tools in place. So there's my credit spread strategy for you all. Here's the iron condor piece that you can turn into and utilize as well when you notice consolidated markets, because if you were to buy options on those days, you're going to get absolutely crushed. Let's go to covered calls and cash secured puts. So I'm going to show you my live little baby account here. So this is my little baby wheel account. So what do we see here? This is DPST. DPST is a leveraged 3x bull ETF that tracks regional banks. This is a stock that I absolutely love. Let's take a look. So if you look at my get rich wheel strategy watch list over here, you'll notice a ton of 3x leveraged ETFs. One of them is DPST. So if we take a look at my account here, this is one of two ways you can make entry when we're using the wheel estate options, max options fucking strategy. Wheel estate is a combination of two option strategies, a covered call and a cash secured put, right? A covered call is simple. Covered call means you have 100 shares of any underlying stock. You must own 100 because options trading, right? When you buy an options contract, what is that? That's the right or the obligation to buy 100 shares at that strike price. That's what an options contract is. So to sell a call option, you have to already own those 100 shares as collateral. So what we have here is you'll notice that I bought 1,200 shares of DPST and I sold 12 contracts at $4.50. Now my average price was my average stock price was $4.60. So I sold an in the money covered call, and that provided me with a very large premium. The premium right here was $107 because I rolled it out 2 weeks. So if we look at that, I sold the $4.50 covered call. I am in at $4.60 and I got $107 each. So if we take the 10-cent difference, that means I have $97 in premium of profitability here if DPSD closes above $4.50 on my expiration date of June 2nd. So that's exactly how that works. A covered call is one of two ways. I call it the premium grab. So you go for what's called a premium grab. You locate a stock that has been beaten down or looking good, and you immediately buy it, right? So let's take a look at DPST here. I entered DPST at $4.60, which was down here somewhere. I immediately turned around and I sold the $4.50 covered call for passive income to get some premium in there. And so owning the 1,300 shares and selling the covered call on it, I'm able to make a whopping $1,500. Let me rephrase this. This account is only fucking $5,700. And so rolling this and compounding the gain of the covered call for the last 3 weeks into June 2nd, so a 5-week trade, I'm going to get over 20% ROI on my small account. I don't need to try and bullshit you or fluff you. Look at the fucking math of the live trading screen I'm showing you in front of me. So you can take this strategy. One of the two ways to enter the wheel is called the premium grab, and you can make passive income. This isn't Apple. This isn't Amazon where you need $10,000 for 100 shares. This is a $5 stock. So you need $500 to buy 100 shares. And with that 100 shares, you can begin selling one call option against those shares. So you entered, you bought the shares, and then you immediately turned and sold a covered call. There's two possibilities when it comes, or there's three possibilities that comes to now on the exit criteria. The first exit criteria of a covered call is that the stock expires in the money and your shares would be called away. So now if it closes above 450, I will lose all of these shares. I will be forced to sell them at 450 with no intrinsic value gain. The second thing that could happen is this underlying stock closes below 450 on my expiration date. Then I keep all the shares and I keep the premium because the contracts that I sold are going to expire worthless. So whoever bought those calls, that contract will now expire worthless. So I keep the shares and I keep the premium. So with those two outcomes, the question I have for you guys is, do you like making money or making money? Because on both outcomes, you're fucking making money. Or the third outcome, it's close to 450. Let's just say it's right around 450. You can roll that option out from 4.5 to 4.5 the next week as a last resort and compound the credit. As you see that I've done here for 5 weeks now, I took the initial play of $45 and I've compounded it to $107. At the same exact play that I was going to exit 3 weeks ago, I am now compounding the gain over time passively. The stock is over $1.50 in the money, I think now, so I'm good. I could take that profit whenever. That's a covered call. Covered calls are a cheat code. They're a long-term best friend of mine. I have them in all of my accounts. The way I look at covered calls, how many of you have looked up dividend investing and knows exactly what a dividend investing is and thinks that, oh, I'm going to hold 1,000 shares of fucking Zero Realty and I'm going to own 1,000 shares of AT&T and in 40 years, I'm going to be Warren Buffett. Well, I got to tell you, that's probably not going to fucking happen because 99% of traders that look at their accounts even once are going to look twice. And when they do that, they're going to most likely liquidate the portfolio or not love the whole get rich slow mentality. What is more realistic, if you want to have your little dopamine fix, is why not sell covered calls? It is high risk dividend investing. That's exactly what it is. You're holding the shares long term. You're making money on the shares long term. The only outcome that could possibly happen that you would lose is what if the stock tanks? What if the stock goes to $2? Well, this is why it's called the wheel. Now you start reinvesting the profits back into the shares. You systematically lower your cost basis on those shares. And now you're able to sell the $4 covered call. And you reinvest and eventually you'll get to the $350 covered call. And eventually when the stock rebounds, because it's an ETF, it's going to hit your strike price and you'll sell for profitability. All in time with this strategy, the realized gains will always outweigh unrealized losses if you choose your stocks and when to enter appropriately. The second way to enter a stock using the wheel strategy is a cash secured put. A cash secured put is different from a covered call in the name itself. It's not using 100 shares of a stock as collateral, it's using cash. So if you wanted to sell a put on the stock, you would simply need $500 in cash. And then you can open up one cash secured put. So if I come to trade and I come here to covered stock, this is a covered call right here. It's one of the option strategies you can use right here in TOS. Buy 100 shares, sell one call option, and your new blended cost basis is $5.51 because you're getting 100 shares at $5.66 and you're selling a $15 covered call. So your new blended cost basis is $5.51. And that's exactly how you can enter a covered call right here. To enter a cash secured put, you can come to options, trade, sell one put. If you sell 10 of them, you need $5,000 in premium. So if I want to sell the $5 cash secured put for June 2nd, right now you're getting $20 in premium on your 500. So $20 on 500, that's just above 3% ROI on your money. And so the outcomes for this are simple. If the stock closes above $5, then you keep the premium and that's it. The trade is done. If the stock closes below $5, now you buy the shares at $5 and you keep the premium. So your blended is actually $4.80. I use this term, I believe I invented it. I call it a blended cost average. We have our dollar cost average of our stock, but over time, as you're making income against the stock, your actual blended cost average drops. And that's where you can continue to wheel and get creative with the opportunities that the stock gives you if it were to go up and down. So this is the second way you can enter the wheel, is a cash secured put. Eventually, you can simultaneously do both. You can enter a cash secured put, and you can go for a premium grab and make passive income. The income can stack up nicely over time, like you see in this small account here. My positions, right? Looking at it right here, you can see that I'm going to make $1,500 when this expires in 2 weeks. And when it does, my small account will be over $6,000. I can pick and attack my next stock. And so I love these leveraged ETFs. They're very high risk, by the way. They do have a lot of high risk potential to go against you, but they also have, what did we talk about before? They have triple the implied volatility. So that's big time money for me. That's why a $4 stock, I'm able to compound such a massive premium, is because of the implied volatility that's involved with these ETFs. My favorite stock of all time is Labu. Labu is my favorite stock. I've been trading it since June of 2022, and I've made over $100,000 wheeling this one stock. It is a biotech leveraged ETF. Why does the contract show red? Because it's down currently, because the stock goes green. Remember, if you sold a call and the stock has a big green day, your covered call will be red because whoever bought that call option will be up, right? And if they're up, you're down. So that's why it's showing red. But when it expires on the expiration date, let's just say I'm down $200 on the expiration date. If it expires and they exercise my call contracts and take my shares away, those losses are gone. And whatever the total premium I received is, that's the amount I'm going to get, the $1,265. I still keep that no matter what. So they can't take that from you once you sell it. With Labu, right? Looking at the options chain, let's take a look. So you want to wheel a stock. You want to be safe. So for me, a play that I was potentially looking at today was Labu, my favorite stock. I love trying to enter it. I was looking to do not a covered stock, but I was looking to go to June 9th and sell the $6 put. So if I can scale into that at $18, right? Just under a 3% ROI. Then I can scale into this options trade. And while Labu drops back down or continues up, I can collect premium while I patiently wait for the stock to drop back down, no matter how long it takes. This is a wonderful company to begin wheeling, slow and small. And right now, you just need $600 to get started. You don't need hundreds of thousands of dollars. You can start small and you can compound the gains. Over time, you can systematically add more while you're investing. It's a long-term strategy that we're hitting in and out with weekly and bi-weekly contracts. That's the way you have to look at the wheel estate. One thing I tell all my students is, how many of you have a mortgage, have a property, right? How many of you have a mortgage, bought a home before in your life? Most of us, right? You're willing to pay off that mortgage in 30 fucking years, 30 years. But if you were to buy 100 shares of DPST for $556 and make 3% ROI back a week, that means you only need 33 weeks to pay off your real estate mortgage, to pay off the cost of those stocks to where they're free. Once you've paid off those stocks and they're free and your real estate is paid off, congratulations, you have a cash producing asset forever. So it teaches you patience. It teaches you how to hold a stock. And the goal is to hold it for a year, selling calls and being able to collect passive income off of the underlying stocks. You can do this on dividend stocks as well. It doesn't matter what you do it on, as long as you're able to enter and systematically use a way of entering to get the most passive result possible. The two ways of entering, the premium grab covered call and the cash secured put. The three main factors I use in my entry criteria is: one, when selling the wheel, I need to know what the ROI is. Am I getting my like 3% on my ROI? That's my personal like go-to is 3%. So if I see a $9 strike price, I want at least 30 to $35 per contract. It's just that simple. Or if we have a $10 strike price, right? Like I want my 3%. Secondly, what does the technical analysis say? So we look at Labu here, we could tell it's broke out pretty heavy, but it's in the middle of a massive consolidation period right now. So it could go either way from here after the big drop today. Very bearish candle. So I want to sell the $6 cash secured puts because it's the bottom of this massive consolidation zone. So that tells me that it's a great entry. Yes, it can drop lower, but we don't have to worry about the lower. We have to worry about making the best entry. So for long term, I like selling the $6 cash secured puts because the technical analysis tells me that is the right level to do so. The ROI at 3% tells me how to do so. Yes, that's why it's one of, Francisco, that's why it's one of the two ways to enter a stock, either the premium grab where you just buy the stock or you enter the stock with a cash secured put. So the technical analysis, ROI, those are two. And the third one, this is an interesting thing that I've developed. I call it weighing the upside potential of a stock versus the downside protection. I don't want to enter this stock at $7 if I think it's going to drop back down to $6. I just won't do that. I practice my patience. I sit back. I sell my $6 cash secured puts. Well, then if $6 hits, then I need to weigh the two factors. Is the technical analysis giving me upside potential where I can sell a $7 covered call, collect $100 of intrinsic value and keep a premium coming in? Or do I think it's going to fall from $6 back down to like $5.50? So then maybe I need to just sell the $6 covered call and keep the premium coming in larger and keep the passiveness and the downside protection side a little bit stronger as well. You need to be able to keep your foot on the gas pedal and the brake at the same time. And when the analysis is saying this stock's got some upside, you sell a covered call out of the money. If the downside protection is more important and you want to be a little risk adverse, then you would sell a covered call at the money or even in the money, going strictly for a premium grab, not to worry about intrinsic value. Does that make sense? So when you're wheeling, you're able to systematically use both of these. And we call it the wheel, and I call it wheel estate because of the reason of you sell cash secured puts and covered calls. You have your stock, you have your cash secured puts, you're making income. The income, then you take a paycheck and you reinvest. Eventually, I'll be able to afford 100 more shares. Once I buy those 100 more shares, then I'm going to add a covered call. And as I'm adding a covered call and I get another $100 worth or another 100 shares worth, I'll add a cash secured put. And so now you're buying stock, selling cash secured puts and covered calls, reinvesting, taking a paycheck, and you're turning the wheel. Once the wheel is turning its own self-sustaining profit machine, you move on to another one and you grow it over time and you continue to weigh all of those factors and pay down your real estate mortgage. That's exactly why it's such a long-term, crucial, and badass options trading strategy for being option selling. When you get, let's just say $10,000. With $10,000, I can go to Labu, my favorite stock, and I can sell 15 of these $6 cash secured puts and 15 of these $6. That's a $260 credit, right? Right here, 260 bucks. So with the $260 credit, I can wait for my result. Remember, my two results are it expires out of the money and I keep the 260 and I don't assume any of the shares, or it goes in the money and I keep the 260 and I now own the shares. And if I own the shares, I can what? Come here next week and start selling covered calls and begin the wheeling process. And if I keep the 260, I only need to do this for 3 weeks. And then I can do what? Reinvest 100 more shares and take a paycheck. Then I am growing my account consistently. If you can't wait 3 fucking weeks to add another passive income machine that's going to pay you $18 a week for your life, think about that. You're growing your passive income in 1 month by $18 a fucking week. And if you do that for 2 months, you're up $36 a week. If you do that for 4, you're at 72. And if you add a fifth, you're at $90 a week passive income in 5 months. In 5 months, you've compounded your gains to a point where no other option strategy can do that passively. None. This is the king of compounding growth. It's dividend investing. That's what it is. But you're taking control of that fucking dividend and you're attacking and you're being aggressive with an annual mindset. You have an annual mindset with weekly and bi-weekly options trading. When you're proficient in your broker, right? How long do you think it took me to log in on Monday or Friday and to look at my stock, understand what the 2 or 3 outcomes are, make the best decision based on the ROI, the technical analysis, and the upside potential versus the downside protection? And how long do you think it takes me to fucking make a decision where I can be the most profitable? 15 minutes? Good. In reality, it takes me about 30 seconds now because I've been doing this for a long time. But for you, if you were to start doing this over time, you'll understand, you'll build it and make it yours, because Big Daddy Max's real estate program is gold, but it may be silver to you. So you need to make it your gold, because trading is for you. I don't give a fuck about you or your bank accounts. You are the only one who can take charge of your own situation. So you need to learn how to make it your own. It will take you a few minutes, 15 minutes a week if you want it. So if you had a couple $1,000s laying around and you're like, fuck it, I need to put this to work, put it to work and start wheeling. Start the real estate, pay down your stock's mortgage, get a cash producing asset that's not going to call you at fucking 2 a.m. And you have the best tenants in the world right here. They don't bother you. They just bring in the cash. And Theta is working for you. He's your full-time employee. He's your maintenance guy at the property. You own a piece of real estate now. Now I have Theta as my maintenance man. He's taking care of the property for me. And I'm just sitting here collecting a paycheck week over week. If anyone else can name me one real estate property deal in the fucking world that they paid $5,000 for and they made $1,200 on that month, let me know. And I have $1.5 million in cash and I'll buy all of them. But the problem is it doesn't exist. It only exists in real estate. You have to understand the long-term mindset, selling options just like this, and the benefits that could happen over time. It's not a quick race. It's very long-term. So that is the covered call, the cash secured put, and the real estate portion of this little free, wonderful masterclass. I want to open it up to some questions. I know I just covered a lot very rapidly, but I want to add it all. I want to give you guys some questions. Remember, also, I'm a real estate investor. I've owned several properties. Real estate investors, when they look for a long-term property, a lot of them go by what's called the 1% rule, which means if you have a $100,000 mortgage, if they have 1% of that as the mortgage, as the rent, $1,000 a month, that is a wonderful, wonderful key way to make cash flow and have a cash producing asset. 1% a month. The real estate strategy has crazy returns when you attack right. You have your entry criteria and you're passive and you're patient. So you will understand in long term how you could sell covered calls, sell cash secured puts, and start producing passive income. Or now, since I opened up the variants of your option selling toolkits, what if you played credit spreads, iron condors, became a very profitable option selling day trader, and then you reinvested those funds into the wheel? That's the max way. So I take that $2,000 a week and I add it to my small accounts until I get them up to $15,000, $25,000. And once they're at $15,000, $25,000, they're producing $200 a week for me every week. And I rinse and repeat this over and over and over and over and over. And now I'm making somewhere along the lines of $6,000 to $7,000 a week selling options. And it took me about 3 years to get to this level. 3 years. Jerry Rice said, if you do what others won't do today, you can do what others can't do tomorrow. And I promise you, if you start taking this serious and you take that long-term mindset I talked about, you can fucking grow and compound like nothing else using option selling strategies. That's my fucking spiel, baby. That's what I'm fucking talking about. Yes.
I don't know how that clap came through the speakers. Sorry if it was really loud. But you needed the applause.
Let me fucking get some LFGs in the chat. Let me get some fucking LFGs in the chat, baby. You guys like that? If I broke it down for you and you understood it, let me get some fucking LFGs in the chat. I appreciate you all for coming. Florida, big South Florida gains. Let's fucking go. That is my bread and butter there. That's the max way. That's how I've been able to accumulate and maintain a large amount of option success by using my option selling strategies and mixing them, getting them completely together to where I can use my day trading profits to reinvest into my long-term profits, compound the gains, and keep the gains coming to where I can take a paycheck full time now. With that paycheck, I'm able to either A, reinvest, B, there's so many good things. There's so many advantages to it. This is amazing. I learned how to buy option signals. I've been spinning my wheels in the market lately. I can't afford to pay training, but I do have $600 to get started with covered calls. Any suggestions to help me learn this strategy? Do I have any YouTube videos? I'm glad you asked. I have a full YouTube course for options buyers that's 10 classes long, about 8 hours, 10 hours. I have multiple fucking covered call videos, and I have my credit spread and iron condor strategy already posted 100% free. And now you're going to get this whole video and recap here in the next week or so. So you'll be able to see all of the option selling strategies broken down for you. If you guys want to join MOT, I'm not here to really push sales. To be honest with you, I don't give a fuck if you join MOT or not. It's a 7-day free trial, and the price of MOT is going up on June 1st. So if you do want to join Max Options, June 1st, the price is going up, 7-day free trial. Do it. Don't do it. I'm not worried about it. It's not Big Daddy Max on YouTube. It's Max Options Trading, MOT. Max Options Trading on YouTube. You guys, I hope you learned something. You guys have been great. Fucking very energetic crowd. Have an awesome, awesome evening. And we'll see you at the buzzer tomorrow.
Love you. Bye.